The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And right now, you should be right in the thick of it. You've either filed, you're thinking about filing, you're thinking about getting your stuff together. You look at what your preliminary, if you've used TurboTax, you think, oh, I don't like that refund. We want to help you. Our phone number here in studio is 803-0930, 803-0930, star 930 and a cell phone. And this week is my week to have Chris here. Hi, Chris.
Hello, Esther.
Well, anything exciting that you've come across so far?
I think, with the scare, with the news, with the refunds, at least most of our clients, we made aware of what was going to happen next year. And they go, oh, we knew. But they're still coming in saying, I'm scared. What's going to happen?
Yeah. I had a couple that the other day said that I should not have soft music playing, but I should have a bar in my corner to help to alleviate the pain. But it's true. If you're somebody like for instance, today I had a gentleman that's an outside salesperson. He had no idea that miscellaneous itemized deductions were gone. So his refund changed from $4,000 down to $1,000. So that's a big swing.
Yep.
So at that point in time, I got to explain to him about changing his pay structure so that he gets reimbursed on an accountable plan from his employer, and he still gets the same amount of money, but he'll save FICA, he'll save tax liability. And for those of you that are finding that, we want to help. You can call EG Tax through our website at egtax.com. And again, if you have any questions, 803-0930, 803-0930, star 930 on a cell phone. And I thought our topic today, and we'll talk about anything tax-related, is the difference between a credit and a deduction.
Yep.
Like I had a lady yesterday that came in and she said, well, I have a deduction that I want to take and it's $4,000. Well, miscellaneous itemized deduction, couldn't do it, $4,000. But I know what it was. She had education credit with she had lifetime learning credit, which is 20% up to $10,000. So she had a $2,000 credit coming. All right. But she wanted to take it as a deduction, and she was in 10% tax bracket. Well, number one, they don't have that anymore.
Right.
And number two, she would have done better with the credit other versus the deduction. So I think people don't know the difference between a credit and a deduction.
Right. I mean, a deduction subtracts from your income.
Multiplied by your tax
bracket. The credit reduces your tax liability after you go to the tax table.
So it's a dollar for dollar deduction.
Yep.
Like for instance, a $2,000 child tax credit, you would need in the 10% bracket $20,000 in deductions,
yep.
Right? But each child is worth $2,000. But if you were to take a deduction, you'd need $20,000 in deductions. So I thought it was important, and I thought what we talk about on today's show is all the and then there's not only the credits, but there's refundable and non-refundable credits, which are really important. So we're going to talk about that too. So I'm Esther Gulius from EG Tax, 803-0930. 803-0930, star 930 on a cell phone. And we're going to go to Gail, who's been waiting from Tonawanda. Hey, Gail, how can we help you?
Good afternoon. I sold a rental property last year.
Okay.
Before I rented it, I lived in it for about 8 years. Will I be paying capital gains?
Well, it all depends. Let's talk about how long you rented it for.
I rented it for about 10, 11, 12, 5 years.
Tell poor Gail the problem.
Well, first of all, how much did you pay for it?
How much did I pay for the property? $94.
Okay, and approximately how much did you put into the property?
In repairs.
In repairs, new roof, bathroom remodels.
Sure. Maybe around 25.
Okay, so about 123.
And what did you sell it for, Gail?
143.
143.
So
And so she's got depreciation.
She's got depreciation.
So on all the depreciation, on the gain, you're going to have to pay on a 47.97 and all the depreciation that you've taken up to the gain. So yes, you're going to pay taxes.
Oh, nice.
Basically, just on the depreciation.
Right, but up to the gain.
Right. I know, but I'm saying because they're really after you take closing costs and all
Right,
that,
right.
it's just going to be recapturing depreciation.
Right, but
Yeah.
that's some number, right? So I would, if she said 10 years that she rented it for?
5 years.
5 years.
About 5, yeah.
So you figure 4,000, so she's got 20,000 in depreciation,
Yeah.
approximately. So that will be approximately your gain.
Very good.
Okay, thanks, Gail.
Thank you so much.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930, and you can text us at 3930, and we got a text that came in.
Yep, it says you keep saying that itemized tax has been eliminated. Is that the same
No.
for a 1099
I never said
contract?
itemizing is eliminated. I said it's different. It's been modified. There's still medical taxes with a $10,000 cap, interest that you pay on a primary and secondary mortgage limited to $750,000, and your home equity had to be used for improvements. Charity, casualty losses for federally declared disaster areas, and miscellaneous itemized deduction not subject to 2%. That's still all in there. The thing is, it has to come over $12,000 if you're single, $24,000 if you're married filing a joint return. And I will tell you, that's one thing I've really noticed is that people that are paying large property taxes and large state withholding are really getting hurt.
Yep. Yeah, the thing that's gone is the job expenses for employees.
Right.
But for independent contractors, that's still
Yeah,
there.
so this gentleman or whoever asked us about it, it was like they said, if you're self-employed, whether you're self-employed, have rental property, self-employed in a business, you're good to go. You take all those expenses, ordinary, necessary, to produce the income. If you're an employee, too bad, too sad. We don't care what you incur. We're not going to let you deduct it. Right? Except on the state. And I actually itemize a lot on the state, but not so much on the federal.
Yep.
Right? Because a lot of those things that they don't allow you to, you can take it on the state. Oh, let's go to Sherry. Hey, Sherry, how can we help you?
Hi. I had somebody tell me that you can do, I guess it's called an equity trust, where you're purchasing investment property, I think it's with an IRA, and not being penalized withdrawing that money.
All right, you have to be really careful with that. Chris, you've dealt with people
Right,
that are
yeah.
doing self-directed
Right,
IRAs.
Yep, it's called a self-directed IRA. You have to have a trustee. It can't be yourself. And I think if I remember correctly, the closest person who handles self-directed IRA as trustees, because it has to be a specialized person, is in Ohio. Okay?
So you have to understand, Sherry, if you're doing rental property with your IRA and you're directing everything, you cannot touch the money. Somebody else has to do all of the financial portion, and so you need a trustee to do that for you.
Yep. So the rent has to be paid to the trust. Cannot be payable to you.
Say I'm flipping a house, and I want to use my some of my IRA money to purchase it.
Okay, first of all, it's very complicated. These things, if they get audited and they can punch a hole in it, it all becomes taxable. So you want to make sure you do your due diligence and make sure that you're using somebody who has a track record of success in audits and that they're going to act in a fiduciary responsibility, which means that they're going to assume all responsibility for all this income and expenses. You really have to kind of take your hands off of the money portion. You can direct what you're doing with it, but you can't really touch the money. And if and really,
Right,
your
you can't
guy
write
in
the
Ohio
checks,
is
you can't-
probably the best,
Yep.
right?
Yeah.
So if you want to email us through our website at egtax.com, we'll be very happy to pass on this person's name. We don't know who they are. We've never dealt with them except for with people that have successfully had self-directed IRAs.
Okay,
All right. Thanks, Sherry.
great.
Bye-bye.
Bye-bye. I'm Esther Gullius, the tax lady from EG Tax. We're going to take a short break. We're talking about credits, how important they are for you. If you want to join us, hang on till the other side of the break, and we'll be with you on the other side. Hey, that's music to type on the computer with. I'm Esther Gullius, the tax lady from EG Tax, and we want to help you with your taxes. 8030930, 8030930, star 930 on your cell phone. I will tell you what I saw this week, maybe 7 or 8 times. Parents that brought in their kids' W-2 and were not going to file them because the kid is their dependent, and they said, they just made a little bit of money. But these kids were getting refunds of $200, $300, $400 because up to $12,000, everything they pay in federal taxes, they get back. And if your kid's working and you're claiming them as a dependent, do their tax return.
That's right. That's right. Yep.
Right?
Not to mention if it's over $3,000, you got to anyways for
right,
New York
because
State.
New York State, they're right. Righto. Let's see. We'll go to Larry in Georgia. Hey, that's my southern gentleman. Hi, Larry. How y'all doing?
I'm sorry. As somebody say, your southern accent is the best. Is the best.
Thank you. What's happening?
Guys, very fast. Who's not Chris? I'm leaving. I'm back home, leaving town March 27th. Be back near the end of April. If I send you all my stuff this week, my friend, can you get it done before March 27th?
Yes, I can.
Chris can get her done, Larry.
Let me say, ask you, darling, in my eyes, Chris walks, well, no, in my eyes, you all walk on water.
You're so sweet. Well, where are you going this time, Larry?
To Thailand, Vietnam, and Cambodia.
Whoa. That's where we're going, right?
Really?
That's my granddaughter wants to go there. So I don't know. You got to let us know where to go when you come back. Okay, Larry?
You are, sweetie. Thank you.
All right. Thank you, sir. Bye-bye. That's Larry from Georgia.
Yep. And somebody wants to know what paperwork to prepare for New York State taxes.
Well, pretty much everything on the federal carries forward to New York State, right? The income. The difference is in the deductions. The federal government may not allow you to take all your property taxes and maybe not all of your interest because maybe your home equity credit line was used for something other than home improvement. So on the federal, you are limited, but on New York State, you can use it. So you want to make sure that if you were an itemizer on the federal, that you look into itemizing on the state. It'll save you something.
Right. And that's one of the other texters said, what's the tax implications of using a HELOC to pay down credit card debt?
The tax implication is that you can't deduct it on the federal, but on New York State, it's still deductible.
Right. So a lot of people with home equity
And then the
loans.
other thing, Bob from Elma wants to put in a new air conditioner. Bah. No, not.
There's solar on it.
Yep.
No.
See, everybody, it's like that commercial I did with the hair and things. It's like old ladies that want to change their hair, and you get used to looking at them, and then they change it again. And so you don't even know what they really look like. I mean, that's how the tax law is. They keep changing it. So what was a credit for energy is no longer a credit for energy except for solar.
Correct.
Right?
Yep.
Okay, let's go back to the phones, and we're going to go to Alan. Hey, Alan, how can we help you?
I was calling about my son. He took time off. His wife had a baby.
Yep.
The Family Leave Act.
Okay.
And he got paid like half his salary for a period of time by an insurance company. He didn't get a W-2 or a 1099 or anything, so how do...
He should.
Where?
He should.
He'll probably get a 1099.
Yep. He should call whoever paid him and find out when they're issuing those 1099s because it is taxable income.
Okay. And where do you list that on the tax form?
Well, it used to be...
It all depends on what form he gets.
Right. Because most of them aren't doing W-2s like they should. They're putting them on 1099 miscellaneouses. And it should go on what the old line 21 for
right,
other
the miscellaneous income line.
Right. So now it's Schedule 1 miscellaneous income.
Right.
Okay. But you got to be careful because some places are recording it in Box 7, which means self-employment.
Got to be really careful. And it's not self-employment.
Okay.
So if you need any help, give us a jingle. We'll be very happy to help you. But, yeah, he should call and find out when they're issuing those. They should have gotten it by now, quite frankly.
Okay, well, tell him that. will he owe FICA or anything?
No, not FICA, but he's going to owe income taxes, federal and state.
Yeah, I figured he did, but I didn't know where it was.
Okay?
Thank you.
Thanks, Alan. You know, it's interesting because technically, employees are paying for their own insurance for the Family Leave Act. In my opinion, it shouldn't be taxable at all.
Right.
So I don't understand how they're making it taxable.
Right. And we've called companies, and this is what they're saying. I
Yep.
mean, people who have researched it.
I'm Esther Golias, the tax lady from EG Tax. Our website is egtax.com. We will help you with tax questions. You can email us at Ask the Tax Lady. If you have any questions, our offices, all 30 offices, are able to answer your questions. You can call and talk directly to a human being. And we're going to go back to the phones. And if you have any questions, 8030930, 8030930, star 930 on your cell phone. And you can text us at 3930. And we're going to go to Jay. Hi, Jay.
Hi, Esther. How are you?
Marvelous. What can we help you with?
Well, I got a question for you. So, my father's 86, and I'm his fiduciary, and I'm his power of attorney, and this was all recent. So, about a month ago, I'm talking to him about filing his taxes, and he tells me he hasn't filed his taxes in 10 years.
Right.
So, he's been retired for quite some time. He goes, well, I don't make enough. Well, doesn't he have to file his taxes every year?
Nope. If you're under, so if there's a minimum filing requirement, this year would be your standard deduction. If your taxable income is under that standard deduction, you don't have to file. Some people want to file because if they're under that minimum filing requirement, some people are going to get a refundable credit. But in your case with Dad not probably having any refundable credits because he doesn't have children at home and he's not working, if he's under that minimum filing requirement, he doesn't have to file.
What's the minimum filing requirement?
For him, it would be 13.6.
If he's single.
Okay, well, okay.
Not counting his Social
Right,
Security.
and this doesn't count Social Security.
Counting Social Security.
Not counting Social Security.
Okay.
Okay?
Yep.
Thanks, Jay. Bye-bye. I'm Esther Golias, the tax lady, and that's people don't understand that there comes a place when your income is so low and the standard deduction is so high that you don't have to file. Now, that doesn't mean that you shouldn't file if there was withholding. If his dad has been having withholding on his pension, he wants to file. That's the only way he's going to get his money back. Then he should also get a hold of the HR department at the pension place and say, stop my withholding.
Correct. Yep.
Right?
Yep. Also, maybe they want to get down his, if it's an IRA, there might be more room to take more.
Boy, and that's a great point, Chris, because there are people, especially married couples, whose standard deduction might be 25.6 or 26.3 or whatever it is.
26.6.
It's 26.6. Where they maybe just have pension, an IRA of $10,000, and they're not paying taxes, and they got room to take more out of their IRA because it would be tax-free, and then you just move it into another investment. And that way, some people are using Roths because they want them to be tax-free. You got traditional IRAs that end up being tax-free if you use planning.
Correct.
Right? Okay, let's go to the phones, and we got Eric in Amherst. Hi, Eric.
Hello.
What can we help you with, sir?
I had a pretty good year on eBay, and I wasn't expecting to get a 1099 out of it, but I did sell over $20,000 worth of stuff. Now, it was all stuff that was kind of collectibles, so I'm not sure how that fits into the tax income and all that.
Well, if you sold collectibles, you have to pay at a higher rate. If it's just like you went on, like some of my clients, they go on the side of the road and pick up garbage and then kind of paint it up and then they sell it on eBay. But if you're selling collectibles are at a 28%
right.
rate.
Such like if you're selling sports memorabilia, coins.
Right. So it all depends on what you're selling. If it's just an eBay business and you're buying and selling, then you have a Schedule C. You're going to put your gross income in, reduce it by the cost of goods sold, reduce it further by cost of shipping, advertising, boxes,
PayPal fees,
office and home, et cetera, et cetera. And on the bottom line, you're going to pay income taxes plus FICA. And you're going to get the 20% pass-through qualified business deduction.
Right.
Okay.
Okay?
Thank you.
Thank you. Well, he was very quiet, wasn't he?
Yeah. Well, that's a lot. We have a lot of people who do eBay, and they don't realize I have to count that as income.
Right. But the important thing is to keep really good track of your inventory.
Yep.
So and the inventory might be, and the other thing is it might be something in your house that you paid $600 for, and now it's like funky, and you sell it for $100. Well, in that case, that wouldn't even be taxable, right?
Right.
Because that's a loss on something personal.
And if it's something you had for a long time and you don't have the receipt, then you're going to pay tax on the whole thing.
That's true. I'm Esther Gillies, the tax lady, 8030930, 8030930, star 930 on your cell phone. We're going to break for news. We'll see you on the other side.
She's in my head.
Frank is in there dancing. You can't dance on top of the counter, Frank. Hey, I'm Esther Gillies, the tax lady, 8030930, 8030930, star 930 on a cell phone, and get Jay down too. He's dancing too. All right, we're here. I'm here from Esther. I'm not sure. I don't know where I'm from. I'm from EG Tax, and this is Chris Fabian, Esther Gillies, here to answer your tax questions. 8030930, 8030930, star 930 on your cell phone, and 3930 if you want to text us.
And I just heard Tiffany's commercial there talking about $8,000 for 4 children.
Right.
Well, they just came out today saying the average refund went up. Well, if you look at the time frame, the early filers are the people
the ones with the $2,000
with the $2,000
right.
with the earned income credit. Let's give them another 30 days.
Yeah.
And see what they're saying.
Right. It's true. All right. We're talking about refundable and non-refundable credits. A refundable credit means they give you money back that you didn't pay in.
Right.
And some of the non-refundable credits is the child tax credit, and that's what Tiffany was just talking about, $2,000 for a child under the age of 17. In the year they turn 17, the $2,000 goes away.
Yep.
And it turns into what we call the family credit, $500. The $500 is non-refundable. The $2,000 is refundable. But once they reach 17, the year they turn 17, it goes away. So you can't prorate it. It's all or nothing at all. All right? Another refundable credit is the earned income credit. You have to have wages and a qualifying child that you maintain a home for, and your income has to be relatively low. And you can have up to 3 children.
Right.
And relatively low, I mean $50,000, right? And that can be a gigantic credit, and that's available on New York State as well. And then there's the dependent care credit for daycare, which is not refundable on the federal, but is refundable on New York State.
Right.
Okay? The American Opportunity Tax Credit for going to college for the first 4 years of continuing education. That's a refundable, partially refundable credit. And if your kids are taking it, you're potso. It's not good. This is not good. You should take it, the parent, even if the kid paid for the education and signed on the student loans. Right?
Yep.
And if you're listening and your kids took it, amend the return.
Right.
Okay. And then off-highway fuel tax. If you're a farmer and you're driving tractors with fuel that you bought at the gas station, you get the fuel tax credit back, right? Excess FICA, more than one employer and your income's over
$130,000.
Right. Then you get that back. Nursing home credit, if you're paying private pay patient in a nursing home, they're charging a 6% bed tax. That's refundable on New York State. Earned income credit for non-custodial parents, if you're paying for child support through a
New York State collection agency.
Thank you. Then you get your income's relatively low. You get the refundable credit in New York State for paying child support through as a non-custodial parent. The 214, that's not very often, but if you have a house under $85,000 and you're a senior,
Yep.
And even if you're not a senior, you can get a refundable credit.
Under $450.
Firefighters credit, firefighter. You get $200 for refundable in New York State, and that's just some of the refundable credits. They pay you if you didn't pay them.
Right.
Let's go back to the phones again. 8030930, 8030930, star 930 on a cell phone, and we got Judy. Hey, Judy.
Hi.
Hi. What can we do for you?
Well, I wanted to check with you. My aunt is 94 years old, and I'm her closest family member that's still alive, and I'm her power of attorney.
Okay.
I handle all of her bills and take care of all of her financial matters. And I'm doing her federal tax return, and it looks as though my power of attorney isn't good enough for me to sign the form for her. Am I reading that right?
Well, the federal government has a separate power of attorney than the normal power of attorney that gives you the right to, go to sign her hospital bills and do her checking account. The IRS has a form called a 2848 that you're supposed to use to sign. But I've never seen them go after somebody for not having that 2848 for elder care, but the 2848 is the one you should have.
Okay, and is that something I just file with her return?
You can send it in with the return. There's also a fax number on it. You could fax it into the IRS as well.
Okay, great. Thanks so much.
All right, thanks, Judy. And let's see, we're going to go to Mike in Batavia. Hey, Mike.
Hello.
Hey, how can we help you?
I bought some rental property in 2018, and I wanted to know if any of the fees, the treasurer's certificate, the county clerk file fee, and what fees would be tax deductible?
Okay, so,
State or federal?
all right, for you to operate your rental property, and especially those of you that want to use the qualified business deduction, you have to make sure that you have a separate bank account and you're spending at least 250 hours a year taking care of it and all that stuff. And all those expenses to run the apartment, your rental properties that are ordinary and necessary are going to be deductible dollar for dollar. In other words, your advertising, your travel, your insurance, your property taxes, your repairs, your utilities,
But what about the initial purchase?
Well, hang on. So that's all deductible. Now, what's depreciable over the life of the property, 27 and a half years, would be the cost of the building plus all the expense of purchase less the land value, and that's going to be depreciable over 27 and a half years.
Okay. So this is essentially those fees and land.
That's all going to go to the basis. So simple math. Let's say you buy a place for $90,000, and at closing you got all those closing costs for the fees and the title and the whatever and the attorney and everything, and that comes to $10,000. So now the adjusted basis is $100,000, and let's say the land is worth $10,000. So you're going to depreciate $90,000 over 27 and a half years.
Okay. Okay. Thank you very much.
You're very welcome. Bye-bye. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Yes, sir.
I know. No, we were just talking about rentals walking in, and the key thing, you got to have that profit motive. You got to run it like a business.
That's exactly right, especially if you want to take the qualified business deduction, right? If you're renting your property under fair market value, if you're renting it to your aunt and your uncle, you got to charge fair market value. Otherwise, the income is fully taxable and you don't get any expenses except for the property tax.
Right.
But I will tell you, a great deduction for those of you that are finding out that you're kind of getting your mojo squeezed here is to do rental property. Rental property is you can take all those expenses to operate the property on your Schedule E. They're not limited as long as you have a business motivation and your income's under $150,000, right? Because at $100,000 they start phasing that out too. Okay, let's go back to the phones and we're going to talk to Alton. Hey, Alton, how can we help you?
Yes, Esther. I called a while ago, and I've been trying to find out, I went on IRS.com, and I owe back taxes. And they took my taxes, my return last year, and I've tried to call and find out, but, it's like sitting on hold for 10 hours, And I called, and I talked to you guys, but you guys said you'd be able to help me find out, but you had to wait until tax time. And I went to Springville and filed my taxes and talked to the guy there, and he couldn't help me out. So I figured I'd give you a call. I just happened to have...
All right, so Elton, it is worth it to wait. And on the phone, I know that it's a long wait, but it is just carve 3 hours out of the day so that you can talk to the IRS and find out what now, are they sending you periodic reports on what your balance due is?
No, I haven't gotten a report since a year and a half.
Okay, are you on a payment plan with them?
No.
How long ago was the debt incurred, Alton?
2015.
And how much was that liability then?
3,000 or 2,000 something, maybe 3,000.
All right, and how much of the refunds have they seized, or how much have you made in payments?
I haven't made no payments, but they seized probably like 2,000. I tried to do try to settle with them. You
mean an offer in compromise? You don't have enough to do an offer in compromise. It's just really small potatoes at this point in time, really. But,
right.
Unfortunately, this is the time of year when we're so busy, right? And so what we said at the office is if you could wait a month and a half, we got all the time in the world to sit down and call the IRS with you. But if you have the time and you can carve out a couple hours, just sit on the phone and talk to somebody about your account. Make sure when you're calling in that you don't say you're calling about your refund. Just you're calling to ask a question about your account, and then ask them what you really owe. Ask them to send you a transcript of your account.
Okay.
All right?
All right, thank you.
We sure want to help you, that's for sure. All right, thank you, Alton. We do, and unfortunately, our hands are kind of tied this time of year. We have to make some money now, or else we're in big trouble, right?
That's right.
I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on your cell phone, and you can text us at 3930, and we got Troy in Gettsville. Hi, Troy.
Hi, how are you?
Good.
Used your service for years. Absolutely love you guys. But
Thank you so much.
You're welcome. Find myself in a new situation I'm curious about. So I have moved into a family home due to a long story, and I'm paying the taxes, but they're not in my name.
Okay.
So if that's the case, can I use that if I can prove that I paid them or not?
It has to be your debt paid with your money. So in a situation where you're paying taxes for somebody else and it's not your obligation to pay, you haven't inherited it, it's not going to be deductible. So what I'd suggest you do is put yourself on the title, if you can. If somebody would let you to also be named on the title, then it would be your debt paid with your money.
Okay, very good.
All right, thanks, Troy.
Thank you.
Bye-bye. I'm Esther Golias, the tax lady, 8030930. 8030930, star 930 on a cell phone. For those of you that, a lot of people think that they should file separately because somebody's got a student loan debt and da-da-da-da. The injured spouse is the form that you would use if, let's say, one of the spouses has an outstanding child support debt, student loan debt, to make sure that the other spouse gets the benefits of filing jointly. There's not too many. Not too many benefits
really
anymore.
Joking, or was that a...
No, there's not too many benefits anymore to file jointly, and that way they won't seize your refund, the non-obligated spouse, the injured spouse. They'll just take the refund for the other taxpayer. The other reason I asked this gentleman that had the obligation, the problem with the IRS is how long it's been since the debt was incurred. If it's more than 10 years, it falls off.
Once they levy.
Right.
So, so if it's 15 and they levy in 18, then they just got to wait to 2028.
Okay, once they levy.
Okay,
let's talk again, 8030930, 8030930, star 930 on the cell phone. So the first group of tax credits we talked about, those are credits, and the Empire State credit, I forgot about that one.
Yep. The New York State, for some reason, ages 4 to 16, they don't care about.
They get $100 a kid, even if you don't have to file.
Yep.
It's got 4 kids, $400. All right, now, non-refundable credits. Now, these would be credits that reduce your liability, but they're not going to They're not going to give you any more than that. And that would be the Child Independent Care Credit on the federal.
Right.
Right?
Yep.
So, and actually, if you have the opportunity to use your payroll deduction, you get a little more bang for your buck.
Right, right. You can save Social Security and Medicare tax on
Right.
it, too.
And then the other thing is the adoption credit. If you are somebody that has adopted a child, you can get a credit of over $13,000 for an adoption, even if it's a foreign adoption. You have to wait until, if it's a U.S. adoption, you can take the credit in the year that the adoption's taken place, even though it hasn't been finalized. In a foreign adoption, you're not allowed to take the credit until after it's finalized. There is such a thing as special needs adoption, where you maybe adopt a child in a sibling group. Maybe you have a 3-year-old and a 5-year-old in a sibling group, and you didn't even have to pay to have them in your family. They still allow you to take the adoption credit on both kids. So over $26,000 in tax savings.
Yep. Yeah. Oh, I had 2 people last night that got to use their credit from previous years because it carries forward.
And the thing is, we're not talking about a deduction of $26,000. We're talking about tax savings of $26,000. Yep. So you just stop your withholding at work and go forward. And then there's the alternative minimum tax credit. So if you had alternative minimum tax last year and this year you don't have it, there's an AMT credit where they give you back the money that you paid in AMT. Lifetime learning credit.
Right. That's for anything after your first 4 years of school. So if you're going to school for your master's, your doctorate, or maybe you're going back for a new 4-year. So after the first 4 years, you get a lifetime learning credit, and that's based upon per tax return. So $10,000 worth of education paid per tax return at a 20% credit.
And it doesn't have to be paid. It can be borrowed.
Right. Student loans. Yep.
Right. So that's lifetime learning. Pension savers credit.
Yep. So if you're putting money in your 401k, or an IRA, a Roth IRA, and depending on your income, the government will give you a little bit of a bonus to say thank you for putting money away.
You can have up to 50% of the money that you put into your IRA, up to the first $2,000, that comes back as a credit. Now, I will tell you this week, with people that were falling on the floor because their refunds weren't what they thought they should be, we've talked. I've had, I would say, 20 or 30 people that said, I'm going to put money into an IRA so that I get the deduction now. I have till up till April the 15th to do that. And they reduce their tax liability or increase their refund. And it's a great tool when you're doing your return to increase, as long as you have self-employment income or wages.
That's right. That's right. You know what?
Under the age of 79.
Interesting story. You asked in the beginning, anything to say. We had someone who had insurance through the marketplace. And
that's a premium tax credit, and you can get that too.
But he somehow, the person who signed him up, I think, didn't include his wife's Social Security, something. So of this whole subsidy, he was going to have to pay back like $9,000. He had a tax balance due, and he's like freaking out. And our preparer goes, do you got an extra $500 in your household that you can put in an IRA? He goes, yeah, but what that's going to do, I owe $9,000. But
they got him under poverty level.
It got him under the 401%, so he didn't have to pay it all back. He only had to pay back $2,000.
Yep.
So that $500 IRA contribution saved him $7,000.
Boy, that's great. And that's the whole thing. That's why you have to thoughtfully think about your tax return. And there are things that you can do to maximize your refund or minimize your tax liability, right? And again, the premium tax credit is somebody that is paying for their own health insurance.
And then you have to reconcile your income compared to what you said it was going to be.
And again, and that's a refundable credit. Nursing home credit on New York. Well, that's a refundable.
The bed tax. That's a refundable
That's the refundable credit.
Yep.
Let's see. What else do I got? What other credits are there? Let's see.
There's the electric vehicle credit on the federal.
Right, and that's, again, a non-refundable
right,
credit.
And now that just dropped from $7,500 down to $3,750.
Right.
But still, if you want an electric vehicle, it's still a little bit something to help
Right,
you.
That's right. And of course, the solar credit.
Yep.
that would be a non-refundable credit, which would be what percentage on the federal?
30% on the federal,
And on New York State?
25% up to $5,000.
And what's the trick? The trick is if you don't have a New York State liability or a federal liability, it doesn't save you anything.
Right. There's no credit.
But if I was somebody that was buying solar and I didn't have any tax liability, I would take a look at, do I have anything that I can cash in now to make it taxable?
Right.
Because if I got this credit hanging out there, I'd want to use on this side, find some income that I can make taxable to offset it with, right? All right. And then on New York State, when you pay New York State taxes, there are things that you should reduce your income on New York State by. First of all pensions that are non-government pensions, the first $20,000, if you're over the age of 59 and a half, is going to be tax-free.
Right.
And you take that as a subtraction on the New York State tax return.
Right, per person. So
per person.
If the husband and wife each have an IRA of $24,000 that they're taken out of, then
$20,000 each one.
Yep.
So then what'll be left is $8,000, and they get to reduce it by their standard deduction.
Yep. And
so they're not going to pay taxes.
And their Social Security is going to be tax-free on New York State.
That's right. Absolutely. Oh, the other thing is I wanted to talking about non-refundable credits. On the on the federal return, there's the nursing home payment as an itemized deduction, but on the long-term care, yes. But on the state of New York, it's a non-refundable credit, but it carries forward.
Yep.
So if you're paying, I did a lady the other day who actually paid like $700 to have her tax return done by a very
Square company?
Well, not a Square company. It was a CPA.
Okay.
Paid a lot of money. They missed the nursing home credit on the state of New York, so we got her back like $4,000. Because if you're paying for long-term care insurance, that's a credit. That's a deduction on your federal return as an itemized deduction. But on the state of New York, it's a carried forward credit.
Right.
So don't miss that.
Yep. And and a lot of people go, why would I want long-term care? It's so expensive. But I tell people, I go, how much?
1 month in a nursing home will convince you.
Right. I say that to them. I go, how much would your policy be? Oh, it'd be like $4,000 a year. And I said, okay, well, 3 years doesn't even pay for 1 month.
That's true.
And their jaw hits the ground.
Absolutely true.
Oh, maybe I'll rethink that.
So if you have a pension from a government or publicly funded pension, how is that handled in New York State?
Tax-free.
Completely tax-free. So if you're in a federal, state, municipal pension, it's all tax-free no matter what your age is.
Yep.
Right? And I don't think they call people and say that we think you included a pension that wasn't taxable. Do you? Does the state do that?
Do they send you a check back? Because
I don't think so.
No.
All right. And Social Security on New York State is totally tax-free.
Yep.
Right? And if you put money into the 529 plans, I don't know how I typed 255, but if you put money into a 529 plan on New York State, again, and it's a great, I just had a couple that just became grandparents. I said, what a great thing to do for your grandchildren. Put money in the 529 plan for them, and it grows completely tax-free if it's used for their education. What a great gift for them. Instead of giving them more candy or another car to run or another video game, fund their college.
Right. Other subtractions for New York State. If you are a volunteer firefighter and you have the service award because you've been volunteer firefighter for years, that's a subtraction on New York State. If you're in the reserves and you get called to active duty, and active duty under New York State law doesn't mean you're in a war zone. You could be called to Wisconsin. You could be called to Fort Drum. And you're active. That's tax-free income on New York State. There's a subtraction for that.
So those are things that you should not be paying taxes on. And then, I guess we've run out of time. I'm Esther Golias, the tax lady. If you need the best tax help for the best fee, you can visit our website at egtax.com, where it'll tell you where all of our offices are. We're open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Have a great week. Bundle up. Let's hope for spring. Thank you. Bye-bye.